Welcome to the Deep Dive. Today, we're looking into a really fascinating, maybe kind of tragic story from the world of DeFi. We're talking about Badger DAO. You might know it as BADGER. It's kicked off with this really smart idea to solve a big crypto problem. But, well, it ended up being more of a warning sign after one of the biggest DeFi hacks ever.
It really is a story of massive highs and then devastating lows. Badger DAO's first promise was huge.
Yeah.
Take Bitcoin, the bedrock crypto asset, and actually make it work for you. At its peak, over $1 billion locked up. $1 billion. But yeah, the story gets defined by this absolutely catastrophic security breach, a sort of desperate attempt to change strategy. And now, well, these final blows in 2025 with exchanges dropping it basically confirms it didn't recover.
Right, so that's what we're digging into today. We want to get clear on what Badger DAO was meant to do, why it all fell apart so badly, and what its situation now really tells us about things like trust and security in this space. Okay, let's get into it. So let's start right at the beginning. Imagine I'm just holding some Bitcoin, maybe for the long term. What real-world problem was Badger DAO trying to fix for me?
Okay, yeah, the basic problem is Bitcoin itself. It's designed to be simple, secure, passive, really. People call it digital gold, right? But the Bitcoin blockchain, its core technology, doesn't support complex code smart contracts like Ethereum does. So if you were just holding BTC...
You couldn't do much with it, like
Well,
lending or earning interest.
Exactly. You're kind of stuck. You couldn't easily jump into all that DeFi activity, yield farming, lending, borrowing that was booming on other chains. Your Bitcoin was just sitting there.
Yeah.
Think of it like having a big pile of gold bars in a vault. Secure, valuable, but it's not generating any income on its own. Badger DAO was basically built to be the middleman. The tech that lets you take your Bitcoin, turn it into a tokenized version like wrapped BTC, WBTC on a chain like Ethereum, and then automatically put that tokenized Bitcoin into different strategies to earn interest for you, all without you having to sell your original Bitcoin.
Okay, so the big idea was accelerating Bitcoin in DeFi. That makes sense. Who are they really aiming this at? Who was the target user?
Well, they were really going after two main groups. First, the Bitcoin maximalists, the long-term HO dealers, often with significant amounts, who wanted to earn some passive income but maybe found DeFi too complicated or risky. And second, the more savvy DeFi users who were looking for yield strategies that were based on Bitcoin, because it's seen as the most stable and reliable crypto asset out there. And their first main product to do this was something called the Sett Vaults. Think of them as automated investment managers, but specifically for these tokenized Bitcoin assets. They'd automatically find the best yields from other DeFi protocols and manage the process for the user. Set it and forget it, kind of.
I remember reading about something else they launched too, the DIGG token. That sounded pretty wild, this elastic supply idea. Was that ever really stable? Sounds risky.
Oh, it was very ambitious and, yeah, ultimately pretty risky. Didn't really work out as planned. DIGG was this early attempt at what they called an elastic supply token. The goal was for its price to always track Bitcoin's price. To do that, it was programmed to automatically change the number of DIGG tokens in everyone's wallet every single day. That's called rebasing. If the price was too high, it added tokens. Too low, it removed them.
Wait, so the amount of tokens in your wallet just changed automatically?
Yeah. The idea was to manipulate supply to control the price. But imagine logging in and seeing your token balance just different. It created a lot of confusion, massive volatility, and supply shocks. People found it hard to understand and trust. It was too complex, and they eventually stepped back from pushing it hard.
Okay, that makes sense. But initially the project really took off, didn't it? Part of that was how they launched, using a fair launch. What did that mean, and why was it a big deal back then?
Right. The fair launch was key to their early success in community building. It meant basically no special pre-sales for venture capitalists or insiders getting tokens cheap before everyone else. The BADGER token, their governance token, was mostly given away through airdrops to people who'd used other DeFi tools and as rewards for providing liquidity. This meant it felt genuinely community-owned from day one, decentralized from the start, and that created a ton of buzz and loyalty.
And that loyalty helped them grow huge, right? Over $1 billion in total value locked TVL. That's massive. But then, December 2021, the crisis hits. This feels like the real turning point. What exactly happened with that $120 million loss?
Yeah, that's the moment everything changed. Badger got hit by one of the biggest single hacks in DeFi history up to that point. Estimates vary slightly, but it was around $120 to $130 million worth of user funds just gone. It completely shattered confidence. And here's the really crucial, almost unbelievable part you need to grasp about the risk here. The hack didn't exploit some super complex bug in their financial smart contracts, the code handling the money and yields. Instead, the attacker found a vulnerability in the front end, the website people interacted with.
The website, not the vaults themselves. How does that even work?
Basically, a compromised API key, like a password for different parts of the system to talk to each other, let the hacker inject malicious code into the website's interface. So when users went to the Badger website to, say, deposit funds or claim rewards, this hidden script tricked their crypto wallets into approving extra permissions that let the hacker drain their funds later.
Oh my God. So people thought they were doing routine stuff, but the website itself was compromised and tricked them. That's terrifying. Losing $120 million because of a website issue, not the core finance code.
Exactly. It was a failure of operational security at the user access point.
Mm-hmm.
It just proved, brutally, that your whole system is only as strong as its weakest link. In this case, that weak link was how users interacted with the platform via the web.
Wow. Okay. I mean, recovering from that kind of loss, that kind of breach of trust, seems almost impossible. So I know the team didn't just give up. They tried a big strategic code, right? They launched something called EDTC. What was that about? Were they trying to rebuild?
Yeah, they knew the Sett Vaults were basically toxic after the hack. No one would trust them. So they went for a full pivot. They launched EBTC in early 2024, trying to create a whole new narrative. EBTC was designed to be the first properly decentralized synthetic Bitcoin. But here's the twist. Instead of being backed by actual Bitcoin, it was collateralized by Ethereum liquid staking tokens, things like Lito's Steth or Rocket Pool's Arth. These are tokens that represent staked ether and earn yield themselves. They made a big deal about the security this time. Public audits trying really hard to show the market, look, we learned our lesson.
A decentralized Bitcoin backed by staked ether. Interesting idea, but it sounds like that didn't work out either.
Sadly, no. The adoption just wasn't there. People didn't flock to it. And our sources are pretty clear. The EBTC protocol was officially shut down, sunsetted is the term they used in June 2025. It just wasn't getting used enough, wasn't generating enough revenue to keep it going. The pivot failed.
Okay, let's talk about the BADGER token itself then. If things had gone well, what was the point of holding BADGER for a regular user? What did it actually do?
Its main uses were tied directly to participating in the ecosystem and, well, making more money. Primarily, it was for governance. Holding BADGER meant you got to vote on how the project was run, future upgrades, treasury spending, that kind of thing, standard DAO stuff. But the really attractive part for users was the BADGER Boost system.
BADGER Boost, what was that?
If you staked your BADGER DAO tokens within the system, it directly increased the APY, the annual percentage yield, basically your interest rate that you earn from Bitcoin Sett Vaults. So it created this direct incentive. The more you committed to the BADGER DAO by holding and staking its token, the higher your passive income stream from your Bitcoin could be.
Ah, okay. So the token's value was directly linked to how well those Sett Vaults were doing and how much money was in them.
Precisely. The value proposition was crystal clear. High TVL meant high yields, which meant high demand for BADGER to boost those yields even further. But when the hack happened and $120 million vanished, boom, the TVL collapsed, capital fled, the yields dried up. Suddenly, the BADGER booth wasn't boosting much of anything. It became almost worthless. And so demand for the BADGER token just evaporated. Its price cratered because its core utility was gone. Just a small side note on tokenomics, it's kind of interesting. BADGER has a fixed supply cap of 21 million tokens, just like Bitcoin, and something like 95% or more of those tokens are already out there circulating. Which means, unlike a lot of projects, BADGER doesn't face huge selling pressure from, like, scheduled team or investor token unlocks in the future. The problem really is a fundamental lack of demand, not an oversupply issue.
Right. Okay, so that brings us to the really grim picture in 2025. The TVL collapse was bad. The EBTC failure was another blow. But you mentioned something even more critical happening this year.
Yes. What really sealed the deal, the sort of final confirmation of the project's decline in relevance, has been the wave of delistings from major crypto exchanges. Between April and July of 2025, huge platforms, Binance, Crypto.com, OKX, they all announced they were removing the BADGER token.
Getting kicked off the big exchanges, why is that so bad? I mean, it sounds bad, but what's the actual impact?
It's devastating for liquidity and accessibility. These big exchanges are where most people buy and sell crypto. When they delist a token, they usually cite reasons like low trading volume, not enough liquidity, meaning it's hard to buy or sell large amounts without moving the price, or maybe failing compliance checks. Losing these listings basically cuts the token off from the mainstream market. It kills trading volume, makes it much harder for anyone, especially larger investors, to get involved, And it sends a really strong signal to everyone that the project is considered, well, kind of finished by the major players.
And the regulatory shadow from the hack never really went away either, did it?
No, absolutely not. That reputational damage is permanent. The US CFTC, that's the Commodity Futures Trading Commission, a major regulator, publicly used the 2021 BADGER hack as a prime example of the risks in DeFi. So BADGER DAO has been living under that regulatory microscope ever since, which definitely doesn't help attract serious, cautious capital.
So the final numbers, you said over $1 billion at the peak. Where is the TVL now?
It's minuscule in comparison. Currently, the total value locked in what's left of BADGER DAO is hovering around $17 to $18 million. That's like a 98% drop from its highest point, maybe even more. And any development work now isn't about growth. The community talks about strategic contraction, basically winding things down, maintaining the bare minimum, not innovating.
You know, this story about a project failing due to complexity and security oversight but still having a strong underlying idea is a great point to quickly pause and remind our listeners of something.
That's right. If you're enjoying how we break down these complex projects into simple pieces and want more reviews just like this, make sure you subscribe to our channel, CryptoBox. We do all the complex research so you don't have to.
Okay, so wrapping this up, BADGER DAO. It started with such a clear, important goal making Bitcoin useful in DeFi, unlocking all that value. What's the big lesson here? The final takeaway from this whole saga?
I think BADGER DAO is really an extreme example, a cautionary tale. It shows that even if you have a brilliant idea solving a real problem, even if you have a super strong community from a fair launch, even if you have top-tier investors like Polychain and Parify backing you, none of that can save you if you have a fundamental catastrophic failure in operational security. That $120 million hack wasn't just about money. It obliterated trust. And when their big bet to recover the EBTC pivot also failed to gain traction, and then the exchanges pulled out, there's really nowhere left to go. But the interesting thing is, the problem they tried to solve, finding a safe, decentralized way to make Bitcoin productive in DeFi, that's still a huge unsolved challenge. It's still incredibly relevant. So the final thought I'd leave you with is this. BADGER's fate really makes you wonder. In this DeFi space, once trust is broken so spectacularly, once your brand is forever linked to a 9-figure disaster, is it actually possible to ever truly recover? To regain that confidence and relevance? It's a tough question.